Hi, and welcome to Slot Leader, your weekly Cardano finance podcast where we bridge the gap between the world of finance and the world of blockchain. I'm your host, Umed Saidov, and in this episode, we have a special guest from the world of development finance and economics. In our special interview with Marina Niforos, who is our special guest, we explore the economic potential of blockchain. She has written numerous articles about the blockchain technology and its potential, and she's going to share with us where the technology could be applied effectively from an economic standpoint. Our interview is filled with a lot of insights and good observations from the professional who has worked in the field of development finance and is a trained economist. So I hope you stay tuned. There's a lot of interesting information in this episode. I would like to take this time to thank everybody who's been watching and listening and commenting and subscribing to our channel on YouTube. Your support has been tremendous. I've had enormous amount of pleasure to interact with every one of you on our YouTube channel. Your comments, I read every one of them. By the way, the camera has been moved if you noticed, so let me know if you like this setup much better. But yes, so if you are new to this channel and you like the type of content that we're putting together, please don't forget to subscribe. It's really important for us to get those subscriptions and make sure that we have a coverage of this Slot Leader podcast. If you are a Cardano stakeholder who would like to support this podcast, you may do so by delegating your stake to our stake pool. Our tickers are Sky and Sky2, and we are very much under the saturation point, which is great for those people who might be thinking about moving their stake before December 1st. As always, I would like to remind our viewers and listeners that Slot Leader is an educational podcast, and as such, we do not provide investment, financial, tax, or legal advice. As you know, every week I take a look at what's been happening in the blockchain industry and talk to you about one or two pieces that caught my attention. And this week, I would like to focus my attention on the interview by Ray Dalio, who is the co-founder of Bridgewater Associates, one of the prominent hedge funds in the United States with more than $200 billion assets under management, as long as I remember. Now, I've read Ray Dalio's books and I've listened to him to his interviews in many cases, and I am familiar with his mindset and his framework. So in this interview, which CoinDesk has written about, he is asked about Bitcoin and cryptocurrencies in general, and he outlines his reservations about Bitcoin and cryptocurrencies in three different categories. He thinks Bitcoin is not a good medium of exchange because not a whole lot of merchants accept it, and he talks about Bitcoin not being a good store of value because it's volatile. And then he talks about the regulatory risks, which I understand where he's coming from, but I don't necessarily agree with him. Let me explain why. I think that Bitcoin is not, at this point, supposed to be something that you would use as cash. So, I mean, his point about Bitcoin not being accepted in merchants, among the merchants, even though that it's not supposed to be, I think you could have more adoption with Bitcoin right now than gold, for instance. Now, his point about Bitcoin not being a good store of value, I think because of the volatility, I don't think that has a fundamental sort of reasoning to exist. And the reason for that is that Bitcoin is a rare digital asset, and as long as people believe in it, just the way that they believe in gold, for that matter, it should perform its function. So, and if you look at the price of Bitcoin, it has done pretty well. I mean, that's what store of value is. Gold is very volatile if you look at it from a very short period of time, but if you over the long run of long span of history, you will see that it has produced pretty good returns, especially against the cash. So, and we also have to realize that the cryptocurrency sphere is not yet fully embedded in the financial world. So it is quite natural to see upswings and downswings in this market because it's not very well capitalized. So I mean, I think that looking at instruments at this very early stage and categorically denying their value proposition may be a little bit, in my view, could be detrimental to your portfolio if you are somebody that invests in this space. So that's basically my view about what Ray Dalio has proposed. Yes, the last one about the regulatory risks. I think he has a point there because if this space grows at a higher pace and governments that do not know how to deal with it, they might be a knee-jerk reaction to ban it, and we've seen this in India, for instance. But I think the governments are coming to terms with the intricacies of this technology, and they need, in my opinion, they need growth. And that growth will come from some space like cryptocurrencies eventually, because this is where the most innovation that I've seen in finance is taking place. So I'm pretty optimistic here, and I know that some of the most developed countries are looking in this space and trying to find out how they could benefit from the growth in this space. So I would like to know what you guys think about this article, about the categories that he describes in that article, and the points that he makes against Bitcoin and cryptocurrencies, which I think they might have merit for somebody who's very traditional and embedded in the traditional finance world. But I think a deep dive into this technology might reveal facts in different light that might change people's views. Okay, so we have Marina Niforos, who is the affiliate professor at HEC Business School. She teaches the course. She's a course leader on future of work and a recognized expert in disruptive technology and innovation policy. She is the advisor to the International Finance Corporation and a lead author of the report Blockchain Opportunities for Private Enterprises in Emerging Markets. She was named as an expert to the EU Blockchain Observatory, and she is an active member of Network for Women in Leadership, a nonprofit promoting women's economic empowerment. And she has more than 25 years of experience in strategy, policy, emerging technology in public and academic domains. Marina, I would like to welcome you to this podcast. Good to have you here.
Thank you. It's great to be here. Thank you very much for inviting me.
Yes. So if I may ask you about how you came across blockchain as a technology and what convinced you to focus your attention on its potential.
So just as an opening, I should say that I'm not a technologist. So that I don't come from the technology space. I'm an economist by training. And around 2016, I made a decision to leave the corporate world as an executive and start my own company. I was advising fintechs, sort of young companies in the fintech space at the moment, and they were experimenting with blockchain. It was very early stages. It was mostly on the transactional aspects of blockchain, basically cryptocurrencies that could be introduced in startups that were looking into digital wallets. And then I started looking into the underlying fundamentals of what blockchain was proposing to do. And as an economist, I was as they say, hooked. I was extremely excited by this potential, this promise of reducing transaction costs and being able to basically re-engineer entire economic systems and business models by removing the need for a third-party intermediary. So anyone who's worked in transaction cost theory and institutional economics knows that this is a major issue in economic development. Where I started my career, I started at the World Bank. And having technology being able to provide tools, practical tools to actually affect that seemed to be very promising. And that's how I started basically back in 2016.
Perfect. And back to the question of you becoming the advisor to the IFC. you came to my radar screen. You popped up on my radar screen after I came across this report that you've co-authored with a lot of other people for IFC. And I wanted to ask you, I believe the first time it was written, it was in 2017. Is that right? And
Correct.
was renewed as recently as 2019. So if we look back at the time when you started writing about blockchain for IFC, which is quite a fascinating report. I really like the way that everything was laid out there, and I will make that link available to my viewers in the foot section, the section, the comment section to the video. But if you look at the strategic and tactical directions that you identified in that report, which ones do you think have gained traction and adoption over the 3 years?
Okay, so let me go back to 2017, because again, at that point, we're fairly at the early stages of blockchain. So I will remind the audience that this was at the beginning of the ICOs. So the first 5 or 6 papers, which was the first report, basically, along with papers from 3 other authors, that I was involved as a reviewer, but not a direct author in some of them. We focused a lot on trying to provide some easy to translate tools for corporate leaders in emerging markets to understand even what the technology is. Because the landscape back then was extremely nebulous. There was very few literature and thought leadership around blockchain. Most of it was around Bitcoin. So there was a lot of confusion also. What is Bitcoin? What is blockchain? Most people thought it was exactly the same thing. And the intent of the IFC was to provide some sort of practical briefs, white papers if you have it, but from the point of view not of a technologist, but of, let's say, a business strategist, to explain both what the potential was for this emerging technology, but also what could be some risks and challenges for those companies, and to be able for them to make an educated decision whether to wanted to jump in or wait and decide if this is a thing that fits their own business strategy. So at that point, a lot of it focused, and there were 2 or 3 successive papers on what was the first field of experimentation of blockchain, which was financial services. And also because one of the main objectives of the International Finance Corporation, which is part of the World Bank Group, is financial inclusion. We looked at specific areas where blockchain was already trying to introduce efficiencies in particular services that had a major impact in emerging markets. So we looked at, for example, at remittances, which is a big GDP lever for many countries, particularly least developed countries. We looked at global payments, again, transfers, et cetera, global transfers, et cetera. And I introduced also the concept of the automated KYC, basically trying to utilize the particular traits of blockchain in facilitating a digital identity in order for, and this was a hypothesis at the time, in order to be able to onboard underserved or not served at all segments of customers in emerging markets that had been disadvantaged by the de-risking phenomenon. And so the fact that many traditional financial intermediaries had either abandoned entirely some emerging markets or had limited a lot their customer base due to rising compliance costs, post-financial crisis and post-Basel. And so that was sort of our main focus. We also added another area, which I thought, and I'm glad to say today, to answer the second part of your question, that I think is the one that has been proven that is the most promising, other than financial services, which is supply chains. And so there also we're trying to make a business case that the problematic of supply chains, complexity, administrative processes that are cumbersome, bureaucratic clearances, multi-jurisdictional. It was a very ripe environment to implement use cases for blockchain, because it was an environment that really had clear need for a trusted party, and there was very little trust among economic participants. And so today, I would say that we've seen a flurry of activity around financial services, either through consortia or emerging startups, whether they're new entrants in the market or traditional players really trying to invest to understand how they can leverage blockchain. And we can explain what the different incentives are for those communities, because not everybody wants to run at the same space for obvious reasons. The big players who are market leaders, or at least high, semi-dominant market participants, will not have the same incentive to move directly into blockchain as sort of innovators who have nothing to lose. So the existing market players will also have to deal with paradoxes of moving into something very new while having to cannibalize part of their existing business if they do so very quickly. So, there are different incentives for everybody, but financial services has seen a major uptake in different asset classes, whether it's from the areas that I mentioned that are particularly important for emerging markets, which is global payments and remittances, to sort of more developed world class of assets, securitization, clearance houses, etc., insurance industry, etc. And supply chains. We've seen there also a number of initiatives. They're either in industry verticals, whether that is luxury industry, protecting IP costs, or food industry, trying to provide some kind of a mechanism for food safety in provenance and tracking of actual goods that pass through the supply chain. So I would say that the most movement that I've seen is in supply chain and in financial services.
Perfect. And if you have a breakdown of these solutions coming into the light, are they mostly private blockchain based, or are they based on an open blockchain? What would be the breakdown if you had that information, or if you have that?
I don't have specific numerical information about that, but using a paper that was done by Catalani Smith, which I cited back in 17, he had a predictive model for the evolution of blockchain, saying that basically in segments where you had market leaders dominant, the probability was higher that you were going to get permissioned blockchains, because it would make the onboarding easier, and it would sort of not threaten as much their incumbent position. Whereas in areas where you did not have dominant players, the barriers of entry were much easier for the much more disruptive players come in and really change the terms of play, if you have it, in the economic field. And I think we've seen that. There was the flurry around the cryptocurrencies, including blockchain, but some others also that were sort of working on open blockchains. But that got followed by sort of the speculative hype around the cryptocurrencies and the ICOs that kind of accompanied that phenomenon. And that kind of, I think, discredited, or at least if you have it, exposed some of the tender underbelly of some of these open blockchains, in the sense that they were not as easily in compliance with existing legislation regarding AML, regarding KYC, protection of investors, et cetera. Since then, and since 2018, I would say, or mid 2018, that doesn't mean it's an either or phenomenon. These phenomena coexisted, sort of consortia forming and a lot of initiatives in corporates and sort of the more backbone functionalities of blockchain, I would say, to the cryptocurrency kind of speculative hype. They happened concurrently, but the ICOs were so explosive for about 18 months to 2 years that it kind of overshadowed the rest. And I think after that kind of got dissipated with some very notable scandals, you started seeing a lot more investment from the private sector side into more sort of thoughtful and purposeful, I would say, experiments around blockchain. So really trying to see how those technologies could be integrated with existing business models, how it would threaten their existing business models, and how they could create new markets. And if you look, for example, some of the data that was done, I think by EY, I mean, there's been an explosion of enterprise blockchain solutions from in the last year alone in 2019. So, and companies seem to be much more focused on trying to navigate what's also an unclear regulatory environment by staying either in hybrids or private, completely private blockchains, because they are also have fiduciary duties and legal responsibilities that they're a little bit they're much more cautious, let's say, that they might be overstepping the bounds of the regulator if they go and participate in completely open blockchains.
I see. But I would like to touch upon the use case of blockchain in emerging markets, which was, I guess, the central theme of that report that you co-authored. So I have seen a very clear-cut solution for many challenges in development banks, including access to finance, supply chain solutions, identity, de-risking the lending markets in emerging markets. So why do we do you think there have been any traction in that regard? Why don't we see more IFIs embracing this technology? And I've talked enough to people in the World Bank and IFC, and the general understanding was still early in its early nascent form, because I think the main sort of logic there is to use the blockchain as an experiment, but nothing has been rolled out in a massive scale that would serve the goals of the IFIs and at the same time leverage the blockchain. Why do you think that is? Unless I'm completely wrong here,
You're not wrong, but I would say that it's absolutely natural, the way of the things have kind of developed. And there isn't, I think, one development institution that doesn't have some kind of an initiative on blockchain.
Mm-hmm.
So the IFC has done sort of the thought leadership, but we've worked also in collaboration with the launch of the blockchain lab. And I think, Stella Mokan and some other people involved in that. We worked very closely together. The UN has its own initiative. The OECD has the Global Policy Center. So each international organization, ILO has its own initiative. The WTO has done 2 or 3 papers on how blockchain could facilitate global trade on supply chains. So depending on their mandate, I think each of them is trying to figure out how to approach this conundrum that is blockchain. And companies are not far behind, because we are seeing, and again, this EY report on the uses of enterprise blockchains is very telling, because they've shown how we have a jump from 5% of companies moving out of the box stage to production rollout in 2018. And that moves to 16% in 2019. Now you will say that is insignificant. I mean, we still have only 16% of POCs that actually make it to production phase. But I would argue that that is actually a quite big change in terms of where we were the year before, which was mostly POCs that would fail or would not be recapitalized to go into the second phase, because a lot of people also didn't have the conviction behind it. Not only not the budgets, but they were doing it out of FOMO, right? So fear of missing out.
Yep.
So if somebody was doing something, then you might slap blockchain on something and put the cover on it, and your stock would go up. So we were in kind of crazy, kind of irrational hype attitudes that thankfully, I think now we've kind of put behind us, and people are starting to roll up their sleeves and try to say, okay, we don't know what it is yet, but we're willing to try it on for size and experiment. And if you're seeing a jump from less than 5 to 16 in a year, I'm very hopeful that you're starting to seeing a critical mass moving into the next stage. Why the DFIs are not doing it more? Well, you have to think that the DFIs are not private enterprises. So they're policy-making institutions or lending institutions or both in many cases. But for them to lend, they will lend to governments, and sometimes they will lend to private corporations like the IFC
Yep.
or the equivalent in the Inter-American Development Bank. But again, most of their decision making will happen once something is sort of become a little bit of a justifiable economic phenomenon to which you can invest. They're not venture capital firms. So a technology that is as early stage and as new as this one, despite its tremendous potential, unfortunately does not find yet in the economies of scale that would be required for a DFI to have a whole lending operation behind it. And so I've seen a number of initiatives though, and I think that's very heartening. I'm going to be speaking at the OECD conference that will happen in November on the Global Blockchain Policy Center is organizing it again this year on remittances. And I'm going to be commenting on a very interesting project that they brought to my attention, where you have the collaboration of a number of stakeholders without whom this business case would not have seen the day. And so the initiative and the original grant has come out of the UN. I cannot say who it is because they want to divulge this during the conference, but it is what I think is one of the most promising areas of remittances, which is using blockchain to securitize the revenues of migrant workers so that they can obtain credit in their country of origin. So it solves one of the major problems that we have in remittances and in migrant workers, which is becoming a real issue, particularly post-COVID. By actually using the mechanism for re-engineering the entire way of doing business, right? So it's not a transfer of funds anymore, but it's the securitization of the revenues, and you're using it as a registry, which I think is sort of the fundamental economic use as well of the blockchain, rather than having marginal, transactional efficiencies, which you could get through other types of fintech.
Yes. No, I mean, it's in my thinking about blockchain, my understanding of blockchain is that it's fundamentally important for economic activity, and its value it stems from being a distributed ledger that's tamper-proof, and you can build all sorts of things on it. From identity to credit scores in developing markets. One of the greatest impediments for financial institutions to go into developing markets is lack of visibility into the credit scores and credit worthiness of its population. So if you solve that problem through generating digital identity and digital, a way to assess credit scores, and then you would take care of a major impediment for financial institutions to go into a country. Now, before it was not feasible because it requires so much upfront investment in education, infrastructure, making sure that the institutions work in a certain way, the legal framework needs to be there, which all of that could actually be turned into a turnkey solution for developing countries. And I see that in my assessment of blockchain as one of the greatest promises of it, and especially the open one, where the open blockchain, where you could tailor it. Let's say if you have a digital identity and you are a resident of country in Africa, that residency that did so to say will have certain properties to it attached to it, and will allow you to keep that identity and anything that's attached to it, be it credit score, as something that's uniquely yours and could be made available to any creditor out there who is interested in you as a client. No, I mean, and in that regard, the promise of enterprise blockchain is interesting also, because I want to one of the biggest impediments that I see for enterprise blockchain to come in and provide these solutions is that the problem of trust. In enterprise blockchain, let's say that the enterprise blockchain was being offered as to house a digital identity. how much trust would you put in the consortium of let's say banks or financial institutions who otherwise own that enterprise blockchain, versus the open blockchain where nobody's in charge and you are your own, you keep your identity to yourself, and nothing or no regime, no corporation can affect it. The only thing that is uh, the only person that could make any changes is you through cryptographic, signing cryptographic messages and whatnot. So given that, can you name any successful enterprise blockchain implementations that would solve current problems in the emerging markets the way that you identify among the development financial institutions?
Well, I mean, there have been a number of consortia, and again, in the paper, this is dating now back to 2017, and the things have evolved a little bit. But we looked at two industry streams that were of particular importance: supply chain speaking. It was in the context of the supply chain paper. But we looked basically as to how supply chains are structured, which is a hub and spoke, right? So you usually have a major player or a series of major players who are multinational companies and who provide sort of the connecting link between emerging and developed markets. And they have in their constellation a host of local or even international suppliers, but they have within their universe a host number of other economic players. So the idea there was, okay, let's look at two industries that are of importance to emerging markets because they provide also a fair amount of the GDP, for example, in agriculture and sort of the food industry. And the second one was pharma because of the impact in reverse order that it has on public health. So on agriculture, which employs a large part of the population in emerging markets, and particularly there's also a gender aspect to that because a lot of them are women, we looked at what were the possibilities to streamline the processes so that you would provide more transparency. And that transparency would work both for the benefit of companies from a safety point of view. Okay, so for example, I'll bring a concrete anecdote, that of Walmart, who was one of the initiators of the food trust that became afterwards, on the basis of a pilot they launched on blockchain, they formed a consortium with other mega distribution FMSG companies to try to mutualize the cost of developing a common industry solution. So I would see that as still an enterprise solution, although it's not particular to one company, but it sort of shows a lot of these initiatives who are not completely open blockchains, but I would call them a little bit hybrids. So it's like a commons, but for the industry.
Yes. Here's the thing that I have a hard time trying to digest, and maybe you, having looked at the enterprise blockchain from the outsider point of view, could shed some light on it, right? My point is that the enterprise blockchain, for it to work, you need to get all the participants in the industry to cooperate, and it's a very hard thing, I would say, from a companies who are from a point of view of a company who is trying to compete against these other companies to actually overcome. And I know that sometimes if you are faced with the prospect of completely being disrupted by open blockchain, that might push these companies to cooperate in order to survive and have an enterprise blockchain. But from a point of view of feasibility, I see a lot of difficulties. And I remember reading an article about the shipping industry adopting a blockchain technology, right? There was, I think it was a cooperation between Maersk and IBM to introduce a ledger, and all sorts of different kinds of questions popped up in my mind as a let's say a competitor to Maersk, right? I would start asking myself, okay, if all my orders or all my shipments are in that blockchain and Maersk has visibility into it, then I'm opening up my books for them to actually, approach my clients. And yes, I am incentivized to keep that one closed because even though that I'm going to be saving in general, and as an industry, you could be saving on the costs, but you are opening yourself up for competition that wasn't there. So how do you see the space developing to overcome these kind of challenges?
Well, this is the issue. I think you put your finger right on it. It requires, and this is regardless of the whether the impact of the technology itself will materialize in 5 years, 10 years, or 20 years, because this is a governance problem. So, and this is a governance problem from an organizational perspective for the companies. They are called to enter into new ways of thinking and new ways of doing business that requires not only competition, on which we've all been trained in business schools, but co-opetition. I'm not even saying it correctly. And so it is a very delicate balance between trying to collaborate with your competitors, as you well said, because otherwise you won't be able to bring into life a new industry that requires some dominant players to put their weight in and collaborate for standards to emerge, neutralize their costs, which are a lot when you're thinking that they're transitioning from a legacy system to something new. And so there's a lot of incentive to collaborate. And yet, as you rightly said, at some point, when the thing starts to work, en plus, as they say in French, it's where the incentives to run away and be the first come into fore as well. And that's why you mentioned that we did the first version in 2017. Then we did a second version where we looked more about what the governance challenges and regulatory challenges were, with about 2 years or 18 months of hindsight now. And we looked at the hard law, which were the regulatory, let's say, concerns and challenges, but we also looked at soft law, what I call the governance challenges from the private sector. And in particular, we looked at consortia, because that's where also some of the governance challenges are happening. A lot of the early consortia people rushed in again under the enthusiasm of this is a great new thing, we all going to be there and we going to collaborate and have the standards, but they didn't ex ante negotiate all of the terms that you would normally negotiate. So some of the things that came out in discussions with people who were participants, and there were some notable exits from the early banking, Goldman Sachs left from one, JP Morgan left from the other, et cetera, is because I think those were not negotiated ex ante. Liability issues, IP issues, who has what when, who takes the decision if to change, let's say, from a certain protocol to another, when do we call it quits, if someone is moving internally faster than the other, do they have veto because they want to delay everyone else while they get up to par? So there were a lot of very sort of terms of engagement that had not been clarified. So I think for consortia, which is sort of the governance layer on top of an enterprise blockchain, because it's not just that the architecture has to work, because these things have to be negotiated. They have to be very clearly negotiated ex ante, even though you cannot foresee everything, but you have to be able to go in as a private company and know that if this, then, right? You have to have your own smart contract before you go in and say, okay, I'm willing to tolerate this up to that. And this is what happens when, I don't like this, I go, but it's a very delicate balance between collaboration and competition. And I think it's going to go on for a while until we actually try to see an emergence of standards, because everybody's trying to get there first.
Yeah, absolutely. Absolutely. And I think, when they are thinking about having a consortia and a set of rules within the companies, there might be the incentives to just call it quits and say, okay, I'm not going to use the consortia, but I'm just going to use the open blockchain version, because then I'm not subjecting myself to the, let's say, 5 or 6 or 10 players that might go against me, but it's an open blockchain that has its own governance mechanism that I would probably trust better than my competition. But regardless of that, I would like to go ahead and ask you this question about the noteworthy developments in the past 3 years that increase the chances of blockchain's adoption in general. Have you seen any movements that increase its probability of adoption in a wider global scale?
Well, on the private sector, I think I mentioned a bit about how we're seeing a lot more investment and sort of involvement, not only of capital but resources. Again, I could share with you afterwards for your audience the references at the EY report that states how many people are now actually within companies. Human capital is dedicated to blockchain vis-a-vis the past, as well as hardcore dollars or euros they're putting into development of these new ideas. But other than the fact that the private sector is mobilizing, I would say one very encouraging trend is also how many regulators and sort of public authorities have also moved from what seemed to be a very defensive position back in 2017. And again, it's the context of the ICOs and a lot of sort of small investors being cheated out of their money, some huge corporate governance scandals, companies who raise millions and they don't have anything behind them. So all these things kind of destroyed part of the market, but I'd like to think of it as creative destruction because it kind of cleared, I think, also the confusion and the concept, mix up about who does what and what the real fundamentals are. And although I don't like to make this distinction between cryptocurrencies and blockchain because they use the technology, but sort of the use cases in real business other than cryptocurrency started becoming much more prevalent after that. And I think the regulator also started listening more because this exclusive focus on crypto transactions lessened a bit. And we started looking at this is not just an issue for the financial regulator, although there's a lot of it that's going to be happening in financial services, but it's happening in energy, it's happening in health, it's happening in IP. It can help us provide the traceability mechanisms to even enforce existing legislation if we design it properly. It can be an enforcement mechanism for sustainability objectives or for anti-slave standards that the companies want to present to their customer. So we started going, I think, from a defensive, this is a bad thing, that's the dark web trying to take over, which was the criticism in the beginning around Bitcoin and then the ICOs that followed, to saying, okay, this can actually have a promise of delivering results not only for the economy, but also perhaps also for the regulator. And then you started seeing initiatives, for example, at the European level with the 3 initiatives that they launched in the last 2 years. One is sort of the European Blockchain Policy Forum and Policy Working Group, which was more like a thought leadership center. Then that was followed by the EBSI, which is governments getting together to try to understand how they need to change. What do they need to consider? What are the legislative issues that they have to be confronted if this thing is going to provide also the legal certainty for investors to come in to support startups and innovators? So all this is kind of it can be a positive, virtuous circle or a vicious circle, depending on, what direction you take. So, and then the European Commission launched the INATPA, which is sort of the business side of things, grouping different small, large, medium enterprises from around Europe, getting them under one umbrella and allowing them to have access also to the regulator. I mean, it's not a regulatory sandbox by any means, but it's a place for dialogue, if you have it, where the regulator is listening to the business, they understand what their pain points are, and they're also on their side that feeds their reflection on when should we intervene, how fast should we go, which is, I think, a big step from we intervene and we shut it down, which was the original. If you recall, a lot of central banks said this should be banned. I
Yes.
remember the annual meetings of 2016 or 2017, where there were declarations by several central bankers saying this is going to be a systemic risk for the entire world. We're going to have another financial crisis, et cetera, et cetera. Now you're seeing a lot of sort of, I wouldn't say embracing all the aspects of blockchain, but they are a lot more reflective on how this can be actually a tool. I mean, there's central banks all over Europe regarding the issue of digital currencies and how that can be another tool in their whole arsenal. It's a far cry from where we were 2 or 3 years ago.
This marks the end of part 1 of episode 9 with Marina Niforos. I hope you join us again for part 2 of the same interview, where we continue to talk about blockchain and its economic significance.